Time for Buy Now, Sell Now Pathshala Bullet episode. The aim of this episode is to help our viewers understand the market jargons and help them make the best use out of all these technical charts available in the market. So let's get on board Kunal Bothra for the same. Kunal, we believe you would be speaking about the 200 DMA, that is the daily moving average. Take it away.
Thank you, Adiraj, for that. Thank you, Vinny. Good morning to all of you. Today's topic is not a major technical jargon, but it's a terminology which is used across the board by even the basic as well as even the pro technical analysts. And the indicator which I'm talking about is a daily moving average. But within the daily moving average, we'll be discussing specifically the 200-day moving average, the 200-day daily moving average on simple terms. Now, why is this, or how is the calculation is? The 200-day moving average is basically derived by taking the average of the last 200 days of closing. It generally maps up as a yearly closing for the stock because we expect around 200 odd trading sessions in a year. So, and the importance of this average is very, very critical because then it helps to identify stocks which are trading with a very strong kind of a trend bias for themselves, as well as it acts as a major inflection points of supports as well as resistances as well. So, I've mapped up the 200-day moving average on the Nifty 50 charts. This is the blue line, as you can see, and the most important point is to highlight the zones where the asset class, index, stock, etc. they managed to take strong support for itself. So if you go back to the first chart where the Nifty 50 was trying to take support at the 200 moving average, look at these points over here. A sharp correction comes by, the correction halts closer to the 200 moving average. We see a strong bounce. Then comes a sharp correction. This was in 2002 start, and the correction halts closer to this 200 moving average trend line, and you see a bounce back again. The moment the index breaks below this average, that's where we say that a downward trend or a downward pressure starts for the index. Then there is a flip-flop action between this 200 moving average. Look at the extent of gaps which have created closer to this 200 moving average. Once the average gets broken down significantly or decisively, we see a sharper downtrend coming back into the indices. Same is the case on the upside. When the index breaks this particular key moving average, you see a stronger trend in play for the index, and that resistance now acts as a support for the index, which is why over the last 1 or 2 weeks I've been consistently highlighting that this 200 DMA should act as a major support for the index, and any corrections towards this average should be taken as an opportunity to go long. We look at the next slide as well for the Nifty 50, and again a very similar kind of a juncture where we look at this 200-day moving average initially acting as a resistance. Once that resistance is taken out, it changes its behavior and then starts to act as a support. So from here on, when the index was taking a resistance at this average, we see this index now taking a support at this 200-day moving average. These are classical trading points. The risk reward over here is extremely high because when you are going against the crowd and being contrarian, it always favors because the risk reward is always in your favor.
Absolutely, Kunal. Thank you so much for that. There is a higher risk, higher reward, but interesting thing to watch out for, 200-day moving average, which everyone keeps an eye out on. But these specific points are something that one should watch out for.